Hi guys, we are back with yet another video, and in this today's video we will be knowing about the DCF model, which actually stands for discounted cash flows. We would be learning everything with very ease today, and we will be understanding what is DCF and how it works, what is the use of DCF to get along better with it. So if we talk about DCF first, so DCF is nothing but, you know, it means that you're checking the worth of a particular company or any company which produces cash by looking at the total cash of that company in the future. So whatever that company is going to earn in future, you are forecasting its worth in today's value. So suppose if I say that a company is expected to earn around 10 lakh rupees in a future. So what would be the worth of that company today is we are discounting that forecast for today's value. It's nothing but DCF model. How we do it, what are the components of DCF, we will definitely let you know in this particular video itself. So hi, thank you so much for joining us today. And this is me, Vishwanath, and I'm here to make your finance easy. So let's start with basics. So what is the basic principle of compounding? First, let us know. Okay. So you have heard of compounding easily in normal day-to-day life as well. So what is actually compounding? So I give you an example. So it's like if you're putting 100 rupees into any kind of investment, suppose which gives you 10% of per annum interest. So the savings that you have put as 100 rupees will be 110 rupees. That is 110% becomes 10 rupees. So 110 rupees after a year. Now, when you invest for another year, 100 rupees won't be invested, 110 rupees will be invested. Hence, the percentage of 10% which you'll get on the second year, that would be 11 rupees. That is 110% ka 10%. 110 rupees ka 10% you will get, which is will make your portfolio to 121 rupees. Again, that 121 rupees is being plowed back, not the 100 original. So in this way, your money is compounded. So compounding means putting the interest you earn back into your investment, like the 10% we are keeping on, accumulating and putting in throughout the year, which makes your money grow faster as you earn interest on interest. So it's like piling up of the interest, and you're getting the profit on it. Not profit, but the percentage remains the same. So, as on the years, we see that original growth is more than the compounding growth as the year goes along. So, we are first talking about basics and to build the understanding and foundation better, and then definitely we'll definitely deep down on our main topic, that is DCF. So next, what I wanted to make you understand is present value of money and future value of money. So whatever we invest today, which is money invested today, is nothing but a present value. Okay. Now on this, what you earn is returns. So suppose you are investing in an FD that is for 5 years. Let's keep it more simple. Suppose you are earning, you have invested some money, 100 rupees into equity share, which is giving you 10% of dividend each year. So 110 rupees is your future value of money, and 100 rupees is your present value of money. Okay. So money invested today plus KEGAR is nothing but the compounding annual growth rate, which is nothing but interest for now. Return I have explained in my different video. You can check it from here. However, for now we just have to understand KEGAR as the return which you get on your investment. So plus that, the money you have invested plus that KEGAR, it becomes the future value of your money, which is money which will you receive in future. Now the question comes in that why do we need to invest actually? So imagine buying 100 rupees coffee today, okay? But as the prices goes up, we know that 100 rupees coffee today, in future it would be 150, right? Because we know that the inflation always persists in the economy. So if you keep that 100 rupees without using it, it values go down because today 100 rupees value would be different in future. Today 100 rupees value can buy you a coffee today, but in future it won't able to buy you a same cup of coffee with the same cup of quantity which was there in the past. That means the value of money is decreasing. That's why we have to make sure that our money is growing. And to make sure that our money is growing, we have to invest. So why do we need to invest? In order to grow our money. Okay, because the value of money keeps on decreasing as the year passes. The When I say the value of money, the value of money remains that only 100 rupees is 100 rupees only, but the purchasing power of that 100 rupees goes down. This is the concept. So whatever we have learned till now, we have an equation that 100 rupees when we put with a 10% of per annum interest, it gives us 110 rupees. That 100 rupees will become 110 after 1 year at 10%. Just give an example. Now, that 110, to earn that 110 rupees, you have invested 100 rupees in the past. That means that result of investing that 100 rupees has given you 110 rupees in the future. If I wanted to discount it, like if someone asks me, so if I am in, suppose I invest 100 rupees today, 1 year later I get 110 rupees. Now someone asks me in future that, hey, how much money you have invested to earn this 110 rupees? I can easily say 100 rupees, right? But when we talk about companies, company do have a lot of forecasting, right? Company says in 5 years we will have this much target, in 5 years we will earn this much profit, right? So if the company is having such aspirations and then they are selling their products, suppose the company says, okay, this is a share that we are launching. We said, okay, why do we buy your share? The company says that in 5 years we will have this much growth. The company A comes and says that my 1 rupee, one share cost around 1,000 rupees. You buy it. I'm inviting you to invest. And I will ask, why should I invest? I want my money to grow, but what if your company doesn't run well? So, what are your future prospects? I ask. So, the company says that for 4 or 5 years later, we would be earning this much of money, because of which your the per share value will also increase and it will give you profit. Now, company gave me a forecast that the company will have this much of cash flows. The company is saying for now we are having cash inflows of like 10 crore rupees. In future, it will be 550 crore rupees. And for that particular value, we are charging you 1,000 rupees today for this particular share. The question arises: shall I buy that 1,000 rupees of rupees of worth of share today? Just thinking of that future value, will that be sufficing this 1,000 rupees that I'm paying? This is nothing but DCF actually. That we are discounting that inflows to today's value in order to determine whether we have to invest in this company or not. In the same way, when we are investing 100 rupees at 10% PA, it is giving in us 110 rupees. After 1 year later, if I ask you how much you have invested, you can easily say 100 rupees. But if I ask you today that for this 100 rupees, does it suffice the value that you are going to earn in the future or not? This is what DCF tells us. So it's like going in past, going not in that sense. That means right now you are making a decision by thinking in a future. The future value, you have to make sure that the future value suffice the present value of the money that you are going to invest. Maybe that 1,000 rupees of share might not of that value. Maybe if we discount it for that future inflows that the company has shown as a forecast, maybe that only suffice to 600 or 700 rupees, or maybe it could be more. But if it would be more, or if it would be less, what model will tell us this? This is nothing but DCF. DCF will let us know whether the money that you are paying today, the discounted money for that future price, will suffice the value or will be of that worth or not. So, how much you should pay today for the opportunity to receive 110 in a 1 year? So, if a company is saying that you will get 110 rupees of your 100 rupees, how much actually money that you should pay today to suffice that value? Okay. So, and also with that, you are earning 10% of interest as well throughout the time, that is compounding. So your value of your portfolio is different and interest is different. So value of portfolio means when I say I'm investing 100 rupees, it becomes 110 rupees, the total value of my portfolio is 110 rupees. But another way, 10 rupees is nothing but my interest. So I should keep on receiving this interest with my 110 rupees in hand. So this two should be there. Okay. So let us more understand about needs and wants, and then we will definitely move towards our main topic, that is DCF. So just like asking for a discount on something expensive, right? We mostly do go in the market and we ask for discount. Here in finance, we are discounting for future money. We are saying that you have forecasted that you would be earning this much. For that money, I need a discount. I'm discounting that for today price so that my investment should suffice. Which brings us to uh, uh, you know the main topic, that is DCF. So DCF means discounted cash flow. Let's break it down to understand it better. See, when we are going in future, the value of money increases because of the whatever we have put as an investor. I showed you example, right? 100 becomes 110, 110 becomes 121, and keep on compounding. Okay. So when we are going in future, our money increases, but when we are coming back, it discounts. All right, because in past the money always goes remains low, but in future we, so future have a value, right? The time has a value, time value of money, that is nothing but future value of money. But when we are coming back to note that how much we have invested, we have always have to focus on discounted value. So that's why discounted. So discounted in simple means what we get for what we get in supermarkets normally, ऐसा समझो. What is cash flow? कितना पैसा नकदी रोकड़ा आ रहा है या जा रहा है? Cash flow means inflows and outflows. How much money the company is earning, maybe from sales or from operations, and how much company the money is paying in a form of expenses like operational expenses, rent, salary, etc. Okay. So inflows and outflows, कितना आ रहा है कितना जा रहा है money, that we have to focus on cash flows. Now discounted cash flows, what does it mean? कि फ्यूचर के पैसों की वैल्यू को कितना डिस्काउंट करूं कि ताकि ये पता चल सके कि मुझे फ्यूचर में उन पैसों के लिए कितना पैसा देना है. दैट मीन्स जो कंपनी मुझे कह रही है कि फ्यूचर में मैं आपको इतना पैसा दूंगी, अभी मैं उस वैल्यू को सफाइस करने के लिए कितना इन्वेस्ट करूं. ठीक है, हो सकता है मैं ज्यादा कर दूं, हो सकता है मैं कम कर दूं, तो मुझे कितना एक्चुअल करना चाहिए ये मुझे बताएगा डीसीएफ मॉडल. दैट्स व्हाई देयर इज अ कंसेप्ट ऑफ डीसीएफ हियर. ओके. सो फ्यूचर के पैसों की वैल्यू को कितना मैं डिस्काउंट करूं कि ताकि पता चले कि आज मुझे उन फ्यूचर के पैसों के लिए कितना पैसा देना पड़ेगा. डिस्काउंट मतलब मेरी एक्चुअल वैल्यू कितनी मुझे पे करनी पड़ेगी. ठीक है. सो व्हाई डू वी नीड डीसीएफ? A lot of reasons are there. So first, to value the shares of the company. Example I gave you. To value of the bond. So company also issue bond. I already explained you. You can check the video here. This is about the ownership fund and borrowed fund. So borrowed fund also have a bond. To value the bond. To value anything that produces cash. This is also one of the thing which DCF helps us. To value a project or an investment, to value entire business, to value income producing property. So even if you are investing in a share market, right, to value the shares as well, the DCF can be value, very beneficial, because company always say it's always available in public domain that these are our forecasting income, this much profit we gonna earn. So if we know DCF, we can definitely know whether the offering that they are doing for their share, the prices that they are asking for today, whether they are sufficing their hopes and aspiration for future or not, and then we can make a decision to forecast. Now see, it's not like that future is uncertain, right? Even if they are saying that we have the forecast of earning 5000 crores, it's not certain that they would earn 5000 crore, right? But we can also play a good game. We can check the previous forecasting of those company. We can check the previous balances of the company, balance sheets of the company, the trial balance of the company, the P&L of the company, just to determine whether how much they have forecasted, whether they have achieved it or not, and then we can decide how much company is valuing. Now we so suppose there is a company A said that we gonna earn 5000 crore rupees in 5 years. Okay. Now how would I say यार this company will definitely earn this or not? चलो इतना नहीं करेगी, थोड़ा आसपास हो जाए ठीक है, बट ऐसा नहीं है 5000 करोड़ बोला किया तो इसने लॉस ही पूरा, ऐसा नहीं. For that, I can check previous year forecasting and how much they have earned. If there is no much difference, then I can say, okay, chalo, first take is done. At least the company, whatever company says, उतना तो कर ही देती है. Now, the second question, okay, this is decided, whatever the company is saying that they would be earning in forecasting as a future, fine. Now, what the company is telling me to buy a share by keeping that future forecasting on sake, whether that price of today would be sufficing or not. This is the question. And this question will having an answer, that is the DCF. DCF will definitely answer this. Okay. So this to value the benefit of the cost saving in a company, when a company is doing cost saving, it is very beneficial that we are doing DCF model. Using DCF model, I will tell you how it happens. It helps us to calculate how much an investment is worth today based on the returns of the future, as I have given you the example of. Now you might be wondering that for companies we do not have the data for future value, right? I will show you how. How do we calculate the present value? अभी बताता हूँ मैं तेरे को. See. So let's understand what are the steps for calculating the cash flow. Then I will also show you an example for better understanding of it. Okay. So right now we are understanding that how we are using DCF actually. Okay. And this is very important because we are building foundation. There would be terms. So the small terms are like a small steps. Once these terms are bundled up, they will become a DCF model. So we have to be patient in this while understanding. So first is that under DCF we calculate something which is known as the free cash flows of the current year. So free cash flows are nothing but the operating cash flows minus the capital expenditure. Okay. So operating cash flow is net income, whatever income that they have, plus depreciation and amortization, plus changes in working capital. Okay. So what is net income? Net income means whatever income that you have received, छोटे मोटे खर्चे net income हो गई, operational खर्चे, plus depreciation and amortization like the wear and tear of assets. Okay, plus changes in working capital. So I already explained you in a video that there are two types of requirements: the fixed term working capital, or fixed term capital requirements, and working capital requirements. uh, Fixed term means land, building, capital that company wants, and working capital means raw material, wages, etc. Okay, so changes in working capital means changes in those operational expenses that the company is paying. It's like if I wanted to explain you how much changed in easier way, I'm saying, not going into the terms of accounting, whatever working capital have the change for a particular period of time that we are noticing here. Okay, so if we add all these three, we get operating cash flows. Simple. This can be taken from balance sheet as well. It's directly net income does not have a particular formula of, nor the depreciation they have, but depreciation is, if we talk about, it's just a wear and tear of the asset that we have, like machinery has. If you buy something today, it won't be of a same value. I'm buying a 10,000 rupees of phone today. Tomorrow it would be of 8,000 value. So that 2,000 is nothing but a depreciation. We can understand in this way. CapEx, expenditure on property, plant, equipment, whatever is the fixed asset that we have, is nothing but CapEx. So once we deduct the operating cash flow with the CapEx, we get the free cash flow. Free cash flow means the company which can use it. It's like free, liquid, pura liquid paisa is free cash flow. Okay. So we got to know how we calculate free cash flow. Now let's understand how we understand from a real example. Okay, so if you see, this is a balance sheet of a company, and here if you see, this is the net cash. Okay, here this net cash has all the things. It has depreciation, it has changes in working capital. Okay, working capital changes means current asset minus current liability, if you wanted to understand, whatever current assets that you have minus current liability. Okay, so uh, here you can see the cash was generated from operations, and then taxes were paid. Whatever they got is the net income. Net income का भी clear हो गया. from the balance sheet itself, if you, this is a cash flow statement to be honest. So cash flow from operating activity, investing activity, and financing activity we have. I also explained this in my one of the video. I will pin it here. So payment for purchase of property, plant and equipment is nothing but your capex, as I already told you. So capex means, simple words, plant machinery which is fixed. Okay, like plant machinery. Machinery is not but kind of fixed. Land. Okay. So when we deduct this with this, we get FCF. Simple. Okay, we can just check the cash flow. These types of cash flows are easily available in public domain. Any company you wanted to search, you can just type the company name in space cash flow of the current year. That's all. You will get the same, and from that you can easily calculate the FCF. As in this example, I have told you. This is one of the real example only which I have taken. Now, see, when we wanted to calculate cash flows for the upcoming years, that means we are forecasting. Now, what example I have given you of the current year cash flows, right? कि आज मुझे जो मेरे पास balance sheet है उसका मेरे पास है. But when I'm talking about discounted cash flows, it means I'm investing my money in a company by thinking of its future prospects. Okay. So मुझे future के cash flows चाहिए होंगे उसके free cash flows. So हाउ डू आई डू दैट? आई विल ऑल्सो डेफिनेटली टेल यू, बिकॉज आज का है वो तो मैं आज का तो मुझे पता है ना कि भाई आज इतना कंपनी कमा रही है, बट मुझे अपना फ्यूचर में ग्रोथ करना है. पैसा आज ग्रोथ नहीं होगा, होगा भी नहीं. एटलीस्ट माई मनी नीड्स 5 years टू ग्रो, बट विद दैट ग्रो there is an uncertainty that money can also be turned into losses. So I have to make sure whatever I am investing, the company should run. The company should have this much backbone that it can actually give my returns back. For that, I need free cash flows. Now, free cash flows is easier to calculate for today because we have a balance sheet, we have a cash flow statement, which I showed you as example in this one. We have this, but what about future? What about the upcoming years? Because that would actually determine whether those cash flows would be sufficing the today's investment that I'm going to do or not, right? So we will be calculating it. I will show you, but before that we have to have some assumptions of. Okay, so we have to observe and calculate free cash flows growth rate. Okay, then we have to check the growth rate for the sector of industry. Growth rate is nothing but how much percentage it is growing. I will show you an example. Then we have to study about the main growth factors of the business and impacting cash flows. Like for example, I will give an example in the next slide. I don't want it to decrease the suspense. And then we check the revenue growth, probability, margins, etc. It's like nothing but checking all the histories, this and that. Okay, but let's understand with the example to make you understand better. So let's take a automobile industry. Automobile, very interesting. So we are forecasting FCF for future years. For that, you have to look at the past FCS growth, industry growth, and company plans. For example, you have to analyze कि पिछले साल में उनकी एफसीएफ कैसे रही. अभी 2025 चल रहा है, 2020 से लेके 2024 तक उसकी उनके कैश फ्लो स्टेटमेंट उठाओ और उसका एफसीएस की ग्रोथ देखो कितनी हो रही है. 2021 में कितनी हुई, 2022 में ज़्यादा हुई, 3 में ज़्यादा, 4 5 कितना परसेंटेज ऑफ ग्रोथ है. यू विल गेट वन इंडिकेटर. सेकेंड इंडिकेटर, उस इंडस्ट्री जिस जो कंपनी में वो है, उस रैकेट टाइप की जो ग्रोथ है वो कैसी है. लाइक ऑटोमोबाइल इंडस्ट्री ग्रोथ है नहीं है, हाँ जी बिल्कुल ग्रोथ है. ऑटोमोबाइल में भी किसकी ग्रोथ है, ईवीज की ग्रोथ है. ईवीज का ज़्यादा चल रहा है, ठीक है ना, रिन्यूएबल एनर्जी को प्रमोट किया जा रहा है. आप ऐसी कंपनी में जैसे मान लो चॉकलेट्स की कंपनी है या कुछ बिस्किट्स की कंपनी में आप सोच रहे हो, ग्रोथ कहाँ है, उल्टा बहुत नीश मार्केट है ना. मार्केट तो बड़ा है बट बोलते हैं ना कि क्लटर्ड मार्केट है, नीश तो नहीं है, काफ़ी बड़ा मार्केट है बिस्किट्स का. बट या अब यू गॉट द पॉइंट राइट. सो इंडस्ट्री में ग्रोथ कैसी है, कंपनी जिसमें आप इन्वेस्ट कर रहे हो उसके प्लान्स कैसे हैं, कोई न्यू प्रोडक्ट ला रहे हैं, मार्केट कैसा है कंपनी का, कौन से लोगों को टारगेट करता है, कौन सी डेमोग्राफी को टारगेट करता है, रेवेन्यू और मार्जिन्स के क्या ट्रेंड है. इन सबको मिला के यू कैन मेक अ रीजनेबल ग्रोथ रेट फॉर द फोरकास्टिंग ईयर. कि हाँ मैंने इतना 4-5 साल की स्टडी कर ली, नाउ आई कैन डिटरमाइन बिकॉज वी गेट अ ट्रेंड when the companies are old, no, there is this something I will also explain you, steady flow. The company does not, when the company is old, or it's like comparatively old, the company does not, do some more kind of stuff which disadvantage them. So it's like a steady growth. So when you see 4 or 5 years, it's a good picture whether the how the company will pertain in the future. So as an example, for an automobile company, check vehicle trade trend, how much vehicles sales that the company is having. The EV transition plans, as I told, historical FCF growths. If the sales and margins are expected to rise because of a new model, forecast higher FCF growth. If industry is mature, pick lower growth. It's easy, right? If the future, if they are not aggressive, like I give you an example. So Ather is a company in EV scooters, right? They have an aggressive sales. The FCFs is high because inflows are high, net income is high, operating income is high. Their margins, we have to check on that. It's pretty much good. And whether it would, if they are not good in present, are there expectations of those, uh, you know, margins to rise? We just have to all bundle up and we have to make some kind of studies for us, which is nothing but growth rate. If I give you an example, so if you see, uh, I have analyzed that 2000 in 2024 the automobile industry in India was this much, and at the CAGR 8.10 they are growing, and at 2029 they would be much above than the 2024 rate. Okay, we can also check like Tata Motors in FY24 year to date, the cash profit was this much, the capex was this much. We can, calculate the FCF for previous. So it's like we are checking the previous studies and we are forecasting for the future. Okay, and how what are the industry competitors, etc. Now we have understood about FCF. Now other thing is terminal value, which is very important. So terminal value represent the value of an investment at the end of forecasting period to infinity. Now see, whenever we are investing, we what we say, okay, so we are investing it for 5 years. Suppose we are even investing it for more than 5 years, but our forecasting done is for limited years. Suppose 5 years only. Okay, so my investment is also for 5 years. My forecasting is also for 5 years. I'm just checking कि भैया ये 5 साल मेरा पैसा मैंने रखा है इस कंपनी में, मुझे 5 साल तो ये अच्छा काम कर ले, उसके बाद अच्छा करे ना करे मुझे कोई परवाह नहीं है, क्योंकि मैं उसके बाद में कैश आउट कर लूंगा, दूसरी कंपनी में लगा दूंगा, उसका फिर मैं FCF फिर निकालूंगा. बट हर कोई तो ऐसा नहीं होता ना. सम पीपल भी लाइक कि ओके चलो अच्छा मान लो मैं 5 years के लिए लगाया, नहीं नहीं यार कंपनी तो अच्छा कर रही है, बट व्हाट अबाउट फ्यूचर, क्या मैं इसको रखूँ क्या? या कोई कोई लोग होते हैं कि दैट फॉर नाउ आई एम इन्वेस्टिंग, आई एम जस्ट डूइंग फोरकास्टिंग फॉर 5 years, बिकॉज सी द थिंग इज दैट इवन इफ यू आर investing it for like 10 or 20 years in a company, no, forecasting can only be done for a shorter period, because from knowing the previous 5 years of trend, you can max to max, forecast for 3 to 5 years more. Who knows what happens after 10 years or 15 years, right? Everything changes, every perspective changes, so you cannot forecast for a longer period of time. So even if you are investing in for 20 years, your forecast will be very niche, but it does not mean that how much time period that you are forecasting, the company will also stays for that period. But our investment is like for very short term. Like suppose I wanted to invest in Reliance, 5 years forecasting, because I cannot do it for much, because I might not know, right, what would be the margins, what would be the profit expectations, what would be the plans of the company after 5 years, right? It would be very hard for me to decide. I cannot calculate growth rate, then how would I forecast, right? So, but the company would definitely stay for more than 5 years. So actually, if I wanted to calculate DCF model, I'm actually much relying on what is going to happen after that forecasting years. The company gonna remain for 100 years. My forecasting is just for 5 years to calculate FCF. But what about that 95 years which is remaining for that company? The main money they are going to invest. The main money that they are going to earn is in that 95 years, not in that 5 years. But we are doing forecasting for only 5 years. Even if we are investing for 20 years in that company, for 50 years in that company, but our forecasting remains niche because we cannot do much, because we can predict at one extent looking at previous forecasting trends. Okay, now what should we do? For this, there is nothing but there's something which is called as terminal value. So forecasting period FCF plus the terminal value, which is the steady period of the company, we club this, and then we put the growth rate into this FCF, and or we put the discount rate on this FCF and get the today's value. We have to discount something, and if something is nothing but the cash flows of the company which the company is going to earn in future. Now that company, the money that the company is going to earn in future, for forecasting period, that is for 5 years suppose, but what about the rest of the period that the company would sustain? We also have to calculate that as well, right? Suppose our investment is for 20 years, but our forecasting is for 5 years. What about 15 years then? Right? But our forecasting is not possible. For that, we gonna use terminal value. So this terminal value, what it does, it starts from the when the last year forecast duration ends. So suppose 0 to 5 years it was here. Here we use the forecasting part, industry trends, margins, sales, etc. From here, the company here it's after this to infinity, wherein the company will, which is also known as perpetuity model, till what time the company will run is known as steady period. Okay, the terminal value starts from the time when the last year of forecasting duration happens. Okay, that means the present value of FCF of forecasting duration is your equals to terminal value. That means whenever your forecasting duration ends the year, whatever value of you have at that time becomes your terminal value. Simple. Okay, now we have to calculate discount rate. We have understood about terminal value, we have understood about the FCF. Now main, calculating the discount rate. So the discount rate is the return you require. That means it converts your future cash to present value. It tells you whatever promise is done by the company, or whatever promise. See, I'm talking about company as well, I'm talking about you as well. You are investing, company is saying we will give you 110 rupees for your 100 rupees. How much invest I should do? The company is saying I'm give you this much money. But to earn that money, how much I should invest is one thing. Second, how much value should I invest in that company who is going to earn this much money? That is also another thing. So I have given you two of the example, that 100 rupees to 110 rupees, and then operating income wala example. It's better to understand that second example, because we always look at company's perspective first, how much they are going to earn and how much should I pay. Okay, so it converts future cash to present value. For company valuation, we commonly use the weighted average cost of capital model, which I have also explained in this cost. We also have a big lecture previously on cost of capital, where I've understood you cost of capital, cost of equity, cost of debt, cost of retained earnings. It's easy, you can just watch that video, and everything is nothing but weighted average cost of capital. If I wanted to explain you better, whatever company procures as a money, ownership fund, borrowed fund, equity, debt, whatever amount that they give back, interest, dividends, right, that is nothing but the cost of the company, and together every is nothing but weighted average cost of capital. Okay, okay, which blends the cost of equity, cost of debt, as I told, by their share in the capital structure. If 100 rupees is invested in the company, 80 rupees is equity, 20 is debt, with that proportion they would be vested in the capital structure. Okay, so higher discount rates reduces present value, so we have to choose a discount rate that reflects risk. That means if I take an example here, we have forecasted, we got a terminal value. Now if we wanted to discount it, we discount with regards to the weighted average cost of capital. Okay, if it is equity, we discount it with a proportion of equity. For example, 100 rupees has the valuation of the company, the money that the company has in their capital structure. Out of that 100 rupees, 80% is equity and 20% is debt. If I'm investing in equity, I will discount it with the equity proportion, that is 80%. Simple. Now I will get my discounted rate. Higher discounted rate reduces present value. Okay. Now what I will use, this 80% I will use on the forecasting prices. And the forecasting income value that I have done, I will discount it. Whether I'm investing in debt, I will use the discounted percentage of the debt. If I'm using equity, I'm investing in equity, I've used the equity percentage, and I will use that in my terminal value and FCF together. I will get the discounted of the present. Now I have to use the discount rate which reflect the risk. If it's a safer business like TCS, Tata, etc., lower rate I would be using. If it's a risky business, I would be using the higher rate. Simple. Now there is something which is known as sensitivity analysis. Okay, so sensitivity analysis nothing but testing the waters in different scenarios. Simple. That means we have the discount rate, we have the growth rate. Now, growth rate, how we got? We got growth rate through checking the margins, industry expectations, etc. And discount rate through terminal value and the uh, FCF combined with the proportion of equity cost and debt cost. Higher the discount rate, higher the risk. Lower the discount rate, lowers the risk. Okay. Now it's not like that we have to just keep, okay, हमें इतना discount rate मिल गया, now it's done, we can invest or not invest. No, see, we have to use the discount rate with a different proportions. It's like growth rate is very fluctuating in nature because we are actually speculating the industry will move this much or not, that much or not. So we can have multiple, choices that this company might, this industry might increase by 2%, might increase by 3%, might increase by 5%. I have three choices, are not apart from this. These are only the bandwidth that that industry has. I can check the discount rate with the different growth rates just to determine in all of the waters where my money stands or my portfolio stands. Okay, and how my value would be shaped up. So let's, once we got everything, then how we analyze the result, let's understand and have a backup better. So I will give you an example of our chart. Okay, so firstly we knew about FCF. So FCF is nothing but fruits you will get in next few years. Okay, 5 seasons of mango. Simple. You are investing in a orchard, and FCF is nothing but for 5 season, first season, how much fruits you will, how much mangoes you will get. Okay, simple सी बात. Terminal value, after 5 years how much fruits you will get. 5 साल बाद भी तो वो ऑर्चर्ड रहेगा ना, मिट्टी तो वही रहेगी, ग्रोथ तो होगी. तो 5 साल तक तो मुझे एफसीएफ बता देगा, फोरकास्टिंग हो जाएगी, फ्री कैश फ्लो. व्हाट अबाउट आफ्टर 5 years? टर्मिनल वैल्यू मुझको बताएगा. ठीक है. डिस्काउंट वैल्यू, डिस्काउंट रेट क्या है? यू वैल्यू फ्यूचर मैंगोज अ बिट लेस. ठीक है, कि जो फ्यूचर में मुझे मिलेगा उसकी वैल्यू आज कितनी होगी. व्हाट इज द टाइम वैल्यू एंड रिस्क एसोसिएटेड. Okay, if we total this FCF, terminal value and discount it, I will get my present worth. What is the worth of that particular orchard or particular mango as well? How much you would pay today for that orchard? You will definitely get to know. If you, so by through this I am making my decision whether I should invest in this orchard or not. Understood? What time value or risk it associates, how much I will get after 5 years, and how much I will get beyond that 5 years. Total multiply by what is the risk associated. Okay, I will get the present worth. So 80% it will give you less only. Simple. So if you pay less than the DCF value, your return will be higher, because suppose if I take that example only, the company have said that 5 lakh crore rupees we will earn in 5 years. So okay, fine, 5 years, 5 lakh crore. Okay, terminal value is also so and so. I got my discount rate this much. Okay, into I will do the discount rate, and I will analyze everything growth rate and I will mix, and I got to know that the value of that per share I will divide them by shareholders jitne bhi there are particular shares in that company capital share capital se, and I got to know if in this way I suppose the company's value would be the per share value for today should be 800 rupees, sorry, should be 1200 rupees, but I'm only paying 1000 rupees for that share, which should have worth of 1200 rupees. That means I'm paying less than the DCF value. Of course, my returns will be higher. Okay, because DCF value tells you the truth. Even if the company is saying 5000 crores का होगा, that I can see by growth rate. भाई पिछले साल उसने 5 साल क्या कमाया? That I can determine. Okay, but whatever they have, I have assumed that 5 years वो सही रहे हैं. 19-20 का ही फर्क रहा है for what they have predicted and what they have got. For that proportion, it should be 1200 rupees. 1180 रुपए, ठीक है ना? But still, 1000 rupees is actually good, and I'm paying less than the DCF value. Of course, my return will be higher. Okay, if you pay more than DCF value, होने चाहिए थे भाई मांग 1000 रुपीज लिए है, डिस्काउंटेड वैल्यू से पता लगा इसकी वैल्यू तो 800 होनी चाहिए. Of course, my return would be lower. This was the concept of DCF. DCF actually tells you whether you should invest in a company's shares or not, or maybe debt, any type of investment. For the company point of view, we can do cost saving methods. There are various multiple ways through which we can mold a DCF. Thank you very much for watching this video. I will be bringing more such content in future, and see you in the next one.